Hi, and welcome back to Hedge Fund Manager. I'm Karl-Mikael Siding. Now let's take a look at the macro picture in this deep dive of meta platforms. And one of the most important things that I like to consider is the overall valuation environment for the entire market. And as you can tell, the price sales kind of valuation that Hussman is using, it's actually a slightly different gauge, but it currently sits 200% above the historic norm and 100% above the last 30-year norm. It might be, of course, that these high valuation multiples compared to the history, they might prevail. Maybe we are actually at a permanently high plateau, which is what they used to say back here in 1928 before the Big Depression. Please note that I'm not calling for a huge depression or anything like it. I'm just saying that we have been at this point before, hoping that we're in a new paradigm of new high valuation multiples. We thought so. Some people thought so around the year 2000 or back in the late 60s, and also now again. And there are always new paradigm arguments for it. For example, that the software companies have completely different business models and therefore should be valued higher, or that growth rates will increase with AI, things like that. But typically it does not pay to hope for extremely high valuation multiples to stay. So I would say that these high valuation multiples are likely to fall for the market as a whole. And that means we are facing a general headwind for the market. However, huge valuation multiples, they don't necessarily need to be a headwind, because having unusually high multiples can also act like a kind of a magnet upward. As long as the market overall valuation multiple doesn't fall below a certain level, it will still be the benchmark that everything is compared to. So that means that for quite some time going forward, we could or should expect earnings multiples to be higher than average, simply because the market is 2 to 3 times higher than its historical value. It is, of course, still a risk to pay too high multiples. Paying too high multiples means that you put your money in the hands of strangers, and in the hand of strangers' kindness. So I would still say that it is a headwind, because these high multiples might mean a pretty negative market going forward. So that's we have a high headwind in terms of valuation multiples. We have market technical analysis, as we pointed out in a video before, is negative, with the Nasdaq below its 200 daily moving average, and also is showing a falling over. And then in terms of actual macro economy, right now, here in April-May 2025, we have a tariff war going on, a trade war. It's the market and the geopolitics are fraught with uncertainties. And not least for companies that we're talking about today, Meta and Google, they are facing regulatory headwinds. We have seen a couple of notable losses for Meta and Google in not least Europe and European regulatory authorities. What we could do, a quite nice way to incorporate these risk factors, is to use to add a few risk points to our relative risk assessment. So we had this table where I said that the risk levels of these companies are 1.2, 1.3, 1.5 times the market, and we could add an extra point or two just to make sure we don't run into these investments too early or have a fear of missing out despite actually knowing that we're probably facing headwinds for some time. So my conclusion of all this is that this is not the perfect time to buy either of these stocks. There are macro headwinds, there are technical headwinds, they are not super cheap, except maybe Meta, but remember also that my Meta valuation was based on a future 30 times earnings multiple, and that in turn was based on a 25% earnings per share growth per year up until that point, and actually 25% on average. That puts quite a lot of onus on Facebook and Mark Zuckerberg to actually deliver, and it also depends on not too negative years in between in this 4 or 5 year period. So Meta, nevertheless, it is enticing, but the stock is also only down by about a quarter from its ultimate all-time high peak. So I would say that it's interesting to start nibbling the share. It currently sits at $546. It was down below 500 for a short time, and I think that if we see a rolling over for the markets, we will also see Meta fall. I mean, it is below its 200-day moving average. So I would set price alarms at around the $400 and $300 levels. Why not 415? You should never really set alarms at the most obvious levels where everybody is looking. So maybe $415 and another alarm at $330, at which point I think it would be very, very cheap. But let's save that for the final summary video in this Meta deep dive.